because we can engage in a high level conversation with our colleagues on the wealth side there, we can understand some of the stickiest problems that they're working on for their clientele.
All right, joining me will be Bryon Lake, Global Co-Head of Third Party Wealth and Chief Transformation Officer at Goldman Sachs Asset Management, who currently offers over 240 ETFs globally, some $100 billion in ETF assets. Of course, that includes their recent acquisition of Innovator ETFs, which that deal closed back at the beginning of April, and I think certainly caught the attention of everyone in the industry. But Goldman has continued to expand their ETF business overall. And so we are going to have a wide ranging conversation on how the firm is approaching the ETF market. We'll talk about that Innovator deal and why they pursued it and how that's going thus far. And then we'll get into everything from the ETF share class structure to Goldman's model portfolio business and some other areas of opportunity moving forward. It should be an excellent conversation. Now, later, I'll be joined by both Josh Jung and Anthony Crinieri of Corgi, who has absolutely burst onto the ETF scene with a launch of over 80 ETFs in just the past month and a half or so. You heard me right. Corgi has launched some 80 plus ETFs in less than 2 months, and they have a bunch more in the hopper with the SEC. And so we're going to discuss their approach to the ETF market as well. And you're going to get to hear a full introduction to their business model and how they're thinking about product development at the moment. And I should mention that back in May, Corgi raised $160 million, which valued the company at $1.3 billion. They were just founded in 2024. And the company is certainly much more than ETFs, as we'll discuss, but ETFs are clearly an important part of what they're doing. So we'll get into all of that with Josh and Anthony. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let me now first welcome in Bryon Lake with Goldman Sachs Asset Management, who is joining me from New York. Bryon, welcome to the podcast. It's always great to connect.
Yeah, likewise, Nate. It's great to see you, and thanks as always for what you're doing in the industry and helping investors and staying on the cutting edge of what's happening out there. There's a ton to talk about.
There is a lot for us to talk about. And I thought we'd start by talking about your role there at Goldman Sachs Asset Management. And I have to tell you, you have one of the more unique titles in asset management, Global Co-Head of Third Party Wealth, which I think that's pretty straightforward, but then Chief Transformation Officer. I like that, but do you want to describe what all your role entails? That sounds very futuristic to me.
Yeah, no, that's great. The Chief Transformation Officer is something that, I it's kind of a title that I wear with pride. I think it encompasses a lot of things. Really, what it boils down to, Nate, is the industry is changing so rapidly. How we need to service clients is changing so rapidly, and so from across GSAM, how we want to think about what we need to be doing to serve clients 1 year, 3 year, 5 years from now is really the essence of what a Chief Transformation Officer kind of role encompasses. And so, we're pressing into the decisions that need to be made today in order to meet our clients where they're going to be a year from now, 3 years from now, 5 years from now. And to your point, that encompasses a lot of things that might be how we interact on a digital level. That might be how we think about our data strategy. And that encompasses, kind of the whole engine, if you will, of an asset manager. And so it's been a blast. What it allows me to do is partner with all of the incredibly talented people across Goldman Sachs and Goldman Sachs Asset Management to make sure that we're bringing out all of the capabilities that we have and delivering them in a way that really keeps the client at the middle of the conversation and brings the best of Goldman to our clients.
So I was correct. There is a futuristic component here. You are looking 3-5 years down the line to see what direction Goldman wants to head. So look, a lot I want to cover. I guess let's just start with this acquisition of Innovator Capital Management, who, of course, they pioneered the defined outcome ETF category. I'm showing there are currently about 180 Innovator ETFs with $35 billion in assets. Again, this deal closed back in early April. I would love to have you take us behind the scenes a little bit on how this all came together and then how everything is going thus far.
Yeah, absolutely. So, first and foremost, from a Goldman Sachs asset management perspective, I think we've got a very clear identity, and we're uniquely positioned across the industry. So, we are a top 5 public active manager. We're a top 6 private alternative manager. I think we're uniquely positioned that we can deliver both of those capabilities. One of the things that we distinctly pride ourselves on in the way that we really engage with clients is solving some of their toughest problems. What are the solutions that we can provide to solve problems for our clients? That manifests in our evergreen alternatives capabilities, that manifests in our direct indexing capabilities, that manifests in our models capabilities, which we can talk about a little bit more, and that manifests in our kind of ETF kind of capabilities. And so that's kind of who we are in our identity as an asset manager. If you think about Goldman Sachs and some of the values that we here at Goldman have, client and client service is one of our four values, and so we feel very strongly about how we can serve clients with excellence through partnership with integrity, and so that's who we are. And then if you think about the innovator business, the products of defined outcome ETFs, those solve a distinct client challenge. Clients that are looking for downside protection, clients that want to, have more of a defined outcome in their strategy. And we can unpack that a little bit. And their culture is a very client-oriented culture. And so when you lined up those two things, the fact that they're oriented around solving some of our clients' biggest challenges with a client-first culture, it aligned so cleanly with who we are here at Goldman Sachs Asset Management. It also kind of energized our entire kind of asset management franchise and really catalyzed us in an exciting way. The defined outcome space is one of the fastest growing categories within the overall ETF ecosystem. And so to take a leadership position in that category with over a 40% market share, to your point, Innovator invented that space back in 2018 and has the most developed product range in that space across all different capabilities, different buffer levels, some of the floor products. That was obviously a leadership position that fit really nicely with what we were doing organically on our ETF business, launching some of our best active capabilities as well. And so, that was kind of the premise around the entire thing, Nate. And then when you think about the relationship that we had with the Innovator team, whether that was the initial founders and Bruce and John, who are, of course, legends across the ETF industry, having founded PowerShares, which coincidentally is where I started my career, whether you think about Graham and Trevor, who are, leading that business, alongside the leadership here at Goldman Sachs, or the 70 plus employees across the entire Innovator franchise that are experts in ETF, in defined outcome, in serving clients. All of these pieces came together in just kind of a really clean and crisp way, and we're really excited about that. To your point, we announced the deal back in December. We closed the deal on April 1st, and frankly, we're off to the races. We couldn't be more excited about telling the story to clients. The collaboration across teams is really profound. The Innovator team is fully now into the broader Goldman Sachs kind of ecosystem. The Goldman team is extremely excited about these new capabilities that they can bring to clients. And so, a lot of what we had kind of pictured is starting to come to life. Now, we're only 2 months into it, but man, are we out of the gates fast and feeling good about the direction that we're headed.
Let me ask you this. So, to your point, obviously, Goldman is now in the leadership position in this category. And I'm curious how you're viewing competition here overall, because as you were alluding to, the popularity of these products has absolutely exploded in recent years. And so, as you know, that always invites competition in the ETF space. So how are you thinking about that aspect at the moment?
Look, we welcome competition. That's a good thing for clients. It's a good thing for investors. It's one of the things I love about this industry. I like to say that we want to live in a good neighborhood, so we care what our neighbors are doing, and we want to be thoughtful about, the overall ecosystem there. The fact is that, we've got the longest track record, given that Innovator invented this category back in 2018. We have one of the if not the most mature product range as far as the number of capabilities. To your point earlier, 180 different tickers, each month for defined outcomes, quarterly, different buffer levels, 10, 15, 30% buffer levels, the floor products that can, kind of kick in at that 10% level. And then the expertise, so having a team that has been working hand in hand with clients over the last, 8 years, for them to understand how to incorporate these into their portfolios, how to discuss them with clients. We think all of those things really differentiate and create a bit of a moat around the business that we have. So, of course, there will be competition. I think there will be creative kind of things that come to the marketplace. We really feel good about the positioning that we have. I'd also say that we've got unique capabilities across Goldman that kind of live in the defined outcome space. Obviously, we've got the premium income strategies that with GPIC and GPICs that we think are, very thoughtfully designed to serve, client outcomes. And that kind of all lives in the same kind of defined outcome category. I think the industry kind of loosely defines it as downside protection, derivative income, and then, upside growth opportunities. And we kind of, see that defined outcome category as being defined, quite widely.
Okay, so that's the defined outcome ETF presence that you have. If we move beyond the Innovator ETF lineup, let's talk about how Goldman Sachs is approaching the ETF market overall. And I thought I might frame this in terms of active versus passive. So bear with me, but if I look at the suite of ETFs right now, the first Goldman ETF that came to market, that was back in 2015. That was a passive product, the Goldman Sachs Active Beta US Large Cap Equity ETF, ticker GSLC. That's currently your most popular ETF by assets. And I believe all of Goldman's early launches in those first several years were passive. However, since then, the majority of the launches have been active. And so I'd love to have you talk about how Goldman is approaching the ETF market overall. Like, how should investors and advisors think about the Goldman Sachs ETF lineup?
Great question, Nate. And, as we think about the entire spectrum of capabilities, to kind of your point, index tracking, index, kind of implementation on up to, active, where there might be a human being that has discretion over the portfolio, and then kind of everything in between. One thing I do know, having a lot of conversations with clients, is they don't wake up saying, I'm looking for a passive capability today, or I'm looking for an active capability today. What they wake up doing is they say, like, I have a particular need in my portfolio, and I'm looking at the different options that I have available to me in order to put that into my portfolio. In the same way that if you were going on a trip, you might say, I feel like taking a convertible today, or I feel like taking a pickup truck today, depending on what the route ahead of you might look like. And that's why it's a great time to be an investor, because you have more options than ever. So if you think about the Goldman Sachs kind of suite of ETFs, which is a franchise now, to your point earlier, north of $100 billion, globally, we do have, strategies that are more index tracking, index implementation. Those tend to be in whatever you want to call it, smart beta, or, factor based, where we're using some of our proprietary investment capabilities, implementing those in a more index oriented way. We then have, more active capabilities, and to your point, we've, been leaning into that. I think that's a function of the conversation that we're having with clients of what they're actually looking for within their portfolios. I think maybe the interesting spot to think about there, is on the fixed income side, which, when I talk to investors, they really do like active management when it comes to fixed income. They want to know that a human being is thinking about duration, thinking about credit quality, understanding the shape of the portfolio that they're trying to deploy. So, we've launched G Bond just recently. That's now over $500 million in assets. That's kind of a flagship active fixed income product that we have as well. And so I think what you're talking about, that spectrum, is a reflection of our overall investment capabilities, where we feel strongly that we've got differentiated content that can that can, provide solutions for investors. And I think, you've seen the industry develop over time from, plain vanilla passive market cap weighted to smart beta to now more of an active approach and a bit of everything in between. And that's how we've kind of thought about it as well. So, more recently, I think, we've leaned into on the more like true active side, discretionary active management. We're taking some of the best active capabilities that Goldman Sachs has on the public investing side, and then making those available in an ETF wrapper. And that's kind of how we've thought about it. But I think what we're showing is, at the end of the day, and you asked the perfect question, Nate, when people wake up and think about Goldman Sachs Asset Management, what should they think? We are trying to solve unique problems for clients. And that's how our range is kind of developed. And so we're thinking about that both with just the ETF lens on, but then more broadly across our entire asset manager.
In terms of your comment there on the best way to deliver Goldman's active capabilities, I know earlier this year, the SEC approved Goldman's filing to offer ETF share classes of existing mutual funds. Can you tell us anything about that in terms of how you're thinking about that as a mechanism to deliver those capabilities?
Yeah, I think that was just a function of making sure that we had that optionality to us. We've, really been focused on launching new products going forward. We've, of course, been really focused on, delivering the innovator capabilities and the roadmap that we have on the innovator side. But that was definitely something that we wanted to make sure we had in our bag. And, I think the industry will continue to, look at that and work through that. This is an industry that continues to innovate. And that's just one of the innovations that I think we'll see over the coming years.
Okay, another area that I wanted to ask you about, and you briefly alluded to this earlier, is Goldman's model portfolio business and just how you're thinking about that overall, because this has become a much more important distribution channel for ETFs in general. And not every issuer has this capability, but certainly Goldman Sachs does. And so how does this fit into your overall ETF strategy?
Yeah, man, Nate, this is one of the areas that I'm most excited about on our franchise. Because I think we have a differentiated proposition. And I also think, more importantly, it solves a real client, challenge. One of the ways that I like to think about it is, ETFs, it's like listening to one song, on whatever your digital streaming, program is. You listen to a song. When you think about models, it's like a playlist. I'm going to a workout. I want to upbeat, electronic dance music, playlist. And you want it to like kind of set it for you because you're going to run for an hour and you want to like keep the energy high throughout that. The platform is doing all the work for you, picking out the dozen songs or whatever that need to go through. That's models, right? Instead of picking one specific ticker and saying like, okay, now let's go find my other ticker. This kind of brings the whole thing. I want to manage risk. I want a 60-40. I want a more income oriented thing. It's like the playlist, and it brings forward all of the different tickers that then satisfy that thing, whether you're going for a workout or you're going for a relaxing walk in the park. And so, that's the real, solution that is providing to investors, for advisors. That saves time. It scales their practice. It gives investors a very, synced up, investment experience. From our side, where I think we're really differentiated is our entire models business is built on the chassis of our multi-asset business, which is one of the leading OCIO providers in the world. And so when you think about kind of OCIO and that's outsourced CIO. So, we work with some of the biggest pensions, endowments, corporations that are saying like, we want you, Goldman, to manage our money across all of this. And the expertise and the scaffolding required to do that well is extreme. You need to have a lot of that. You need to be able to do research on public side, on private side. You need to be able to think about how the mix of the portfolio comes together. We leverage that entire kind of infrastructure and then deliver our models business off of that chassis. And so, if you're interacting with a model from Goldman Sachs, you are getting kind of that institutional grade OCIO, just like some of the biggest institutions in the world, delivered to you and, maybe an individual's account. And so the ability to do that, I think, is differentiated from the rest of the marketplace. That also is understanding how to incorporate the different types of strategies that we talked about earlier, whether that's, more, kind of more of a smart beta, whether that's more of an active, or even incorporating public and private in the convergence of the portfolios as well. So, I think that's a fascinating conversation. I think the models business is going to continue to, grow at a very rapid rate going forward. And, the differentiation will come in where firms can support the models business with, excellent investment capabilities, people, content that can be delivered to investors. And I think we're well positioned to do that.
Extremely well said. I don't think there's any question that aspect of the wealth management business model portfolios is going to grow tremendously, and ETFs are going to play a central role there. I've talked about this for a while, and I've seen nothing to indicate that is slowing down anytime soon. Okay, Bryon, so we've talked innovator ETFs, active ETFs, model portfolios. I guess let me ask you about one of the unique aspects of Goldman Sachs, and that you have a very large wealth management business, right? A very prominent wealth management business. And so I'm curious, besides the areas we've already discussed, as you look at that component of GSAM, are there any other big ETF trends standing out to you? Anything in particular that you're seeing from the wealth management side?
Well, it's a great question, Nate. And I think the important thing that I would say there is, because we can engage in a high level conversation with our colleagues on the wealth side there, we can understand some of the stickiest problems that they're working on for their clientele. And whether that's, the ultra high net worth that they work with, or some of the unique things that come along with that, we can then take those, and then that informs what we're doing for investors, in our third party wealth business, or externally serving those clients. And we've touched on a number of the key things with that, Nate, but just to kind of, pull that together. So, the models business, like we just said, is kind of institutional grade. How do we think about how we bring an entire portfolio together, deliver that at scale to a financial advisor or an individual? The convergence of public and private is a big part of that. How do we start to think about private capabilities going into a broader asset allocation, and the mix of those things? Obviously, we've seen in the news recently with recent, private companies going public, and, investors wanting to have those things within their portfolio. So that's a big theme with it. Defined outcome is a really big theme of that as well. Investors that want to understand, like, here we are, and, I don't want to timestamp us too much today, but, markets close to or at an all-time high, and investors are opening up the newspaper, and there's still lots of risks out there. And so if I've got a lot of cash on the sideline, how do I deploy that cash in a mindset that we're at an all-time high, but I want to participate in some of the growth that's going on? A defined outcome or a floor ETF like S floor, where you get S&P 500 exposure, but a floor where you only take 10% of the downside, is a really interesting way to start to put that money to work. We're seeing financial advisors do that. That's a great client conversation to have. Yes, I recognize that markets are at all-time highs. What if we said we could put you into the market, but the worst you could have is like a 10% down over the period of the defined outcome? And so that's a really interesting conversation that we're having as well. So those are all kind of informed by the wealth conversation and the high level. By the way, we inform that by talking to some of the our external clients, of course, as well. There's a ton of platforms out there that have perspective. We take that in. We think about how we can deliver capabilities to investors. And I'd be remiss to say if I didn't mention our direct indexing capability as well there, where investors are increasingly aware of kind of their tax profile. We now have technology that unlocks that potential for you to have an individual tax experience with a direct index that also can change your overall profile from an investment perspective as well. So a lot of challenges. We think we're stepping up to provide a lot of solutions to those challenges, and we're excited to go on the journey.
Okay, so that's the wealth management side of the business. We have just a few minutes left here. I'm going to close by asking you about retail investors, because this is a rapidly growing segment of the ETF market as well. I think everybody knows wealth managers are certainly huge drivers of ETF flows, but I'm curious how you think or what you think about retail. Is this a space that Goldman Sachs has an interest in, or is the focus much more on other channels like wealth management?
Yeah, no, I mean, so it's a reality of our marketplace, right? And when you have an ETF and you listed on an exchange, that makes a lot of people eligible to buy that. From a servicing standpoint, we of course encourage those people to get professional advice or to do their own research or interact in those ways. But the reality is a lot of those investors are very informed. there's great resources like this podcast and many others where they can do their own due diligence. And when I've kind of had those conversations with individuals on the street, they're always very sharp and on top of all of these these topics. And so it's incumbent upon us to make sure that we're providing as much information for investors as they can. And I think that manifests in a digital way, in some of the professional things that we do in different social in different social arenas as well. And so that's kind of how we're thinking about the business. Again, I think we'd be remiss if we ignored that population. We love that population. We welcome them. And we know that we're already interacting with them in a number of different ways. I think a platform like this where we can educate them or engage in the dialogue with investors is a great opportunity for us as well. And so I think that'll be a journey that we're on with investors, and we look forward to those conversations as well.
Well, Bryon, perfect spot to end our conversation. Excellent tour through what's going on with Goldman Sachs Asset Management ETFs. Always enjoy visiting with you. Really appreciate you taking the time. Thank you for joining me.
Hey, Nate, thanks for having us, and it's a pleasure. And keep going. I love the podcast. It's great.
Thank you. That was Bryon Lake, Global Co-Head of Third Party Wealth and Chief Transformation Officer at Goldman Sachs Asset Management.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Josh Jung and Anthony Crinieri of Corgi, who currently offers nearly 90 ETFs, approaching $600 million in assets. And as I mentioned at the top, the vast majority of these ETFs have launched in two waves just over the past couple of months, two record-setting waves, 34 in one and 35 in the other, again, in the span of less than 2 months. And it looks like more ETFs are on the way. Josh and Anthony are now joining me from San Francisco and Chicago, respectively. Gentlemen, it is a pleasure to connect. Thank you for joining me.
Great to see you, Nate.
All right, so there is a lot I want to get into, but I thought let's start with some background here. And we'll certainly get into the ETF business here in a moment, but I'd love to have you first just tell us more about Corgi overall. And Josh, I'll have you do that for us.
Yeah, sure. Happy to give the intro on Corgi. So we're an AI-first full-stack insurance carrier where we're working hard to transform some of the largest industries in the way they work with insurance. Traditionally speaking, within insurance, there's a ton of these many different middle layers. It could be underwriting, it could be claims processing, it could be general, policy administration. And what we're trying to do is we want to bring all of those in-house, which bears two things. One being we have much better pricing since we're not adding a premium at each and every layer. And then we're a lot more timely in the sense that what usually takes days or weeks to fulfill very niche insurance requirements, we can do in a matter of minutes. So that is a quick intro on what we do at Corgi.
And what was the background on starting this company? Like, what was the opportunity that was seen in the marketplace, or perhaps existing gaps in the marketplace that Corgi thought it could fill?
Yeah, so if you really think about insurance, it's a business primarily made up of a lot of words, numbers, and a ton of documents. And with the emergence of AI and large language models, if you think about it, it can process all of these things within seconds or a short minute. So I think there's an element of it being the right place at the right time for these sorts of disruptions. And Nico and Emily, who are the co-founders, they've had previous businesses together where they've had bad experiences with business insurance. And we talk to a lot of founders around us these days, and they see insurance as a bottleneck, and we want to change that. So it could be as simple as getting a commercial general liability policy for moving into a new office, and you might lose it because you don't have insurance in time. Or it could be locking down an enterprise contract where you don't have the right E&O, errors and omissions policy, or cyber policy. Then it's unnecessary hold up there. So those are the things that we want to solve, and that's why we got into it.
Okay, so you've talked about the insurance side of the business. Let's now talk about the ETF side of the business. You do have this asset management arm, Corgi Funds. Why did Corgi want to get involved in this space?
Yeah. So within insurance, there's two areas. There's the liability side of the business, and then there's also an asset side of the business, which is where most insurance generate lot of revenue from. We wanted to invest our assets into places that we believed in ourselves, and we thought it'd be great to kind of offer that same optionality to the retail traders out in the market as well.
Okay. And Anthony, let me bring you into the conversation here. I'd love to have you talk about the higher level strategy of essentially blanketing the market with ETFs. Again, I'm showing Corgi already has the two largest launch days in ETF industry history. You launched 34 ETFs on a single day back in early May, and then 35 ETFs on a single day earlier this month. I'll tell you that's not typically what we see in ETF land. I would say issuers in general, they tend to launch a product here or a product there, unless it's a particular suite of ETFs, but you don't typically see these massive waves. So what was the thought process behind that strategy?
Yeah, for sure. I think just starting, I think the ETF market is as exciting as it's ever been. We're seeing a record number of fund launches over the last few years. And I think more and more people are understanding the benefits of kind of utilizing the ETF wrapper. I think Corgi's taking a complete outsider's approach to the industry. We're shaking up the status quo of what it looks like to be an issuer. Majority of our team actually comes from very unconventional backgrounds and hasn't really worked in the space before. We're predominantly made up of ex-founders, so having our own businesses prior to this, or current engineers, and just people with unconventional problems who are unconventional backgrounds who have been able to solve, a number of problems. So we're taking this, challenging the status quo of what it looks like to be, a traditional ETF issuer, if you will. And so what you see and what we do, it kind of goes against what others have done in the past, and I think that's very much purposeful. So if you look at a large number of launches or rollouts in a single day, whether that was intentional or not, it gets people to speak about us. It's unconventional PR. It's marketing methodologies that are don't cost us any money, and unconventional marketing strategies are no stranger to Corgi. We even have our own 24/7 cafe operating in San Francisco, which might seem crazy for an insurance company, but it's been one of the best marketing tactics for our business. We're bringing together tons of founders and venture capitalists who are building their next big idea at the Corgi Cafe, and that allows us to also preach our businesses at a common ground. So we're no stranger to unconventional practices here at Corgi and how we go about marketing. And kind of going back to the ETF business, this outsider's approach really allows us to challenge the status quo of what it looks like to build an ETF issuer from all angles. So from conceptualization all the way through launch. We're scrutinizing a lot of the costs that we think a lot of people see as status quo. We're internalizing a lot of the processes. We're leveraging AI to the absolute max that allows us to kind of, utilize AI from the ground up and save on costs, but also maximize our time. One of the things we do here at Corgi is we do all work 7 days a week, which I don't think can be said for many other issuers. And that time allows us to continue to build fast. And you're going to see us, launch 88 ETFs in less than 2 months. We filed for a lot more than that. And so, we're building things a bit differently from the rest of the issuers on the market. And we think that's a strength, not a weakness.
Yeah, and just for listeners, I will tell you, Anthony is not joking about the 7 days a week or the 24/7 Corgi Cafe, because in interacting with the Corgi team, I was getting emails like at midnight or 2 in the morning on, say, Saturday or Sunday night. So I can vouch, you guys are all in. I would say this classic sort of VC mentality. Josh, anything you would add here just in terms of the higher level strategy with ETFs?
Yeah, I think the key here is that we want to offer a broad menu approach for ETF selection, and we believe in general more access is key and more choice is better. So we'll have a lot more of these coming up.
Yeah, and Anthony, maybe you can talk a little bit more about that just in terms of the categories that Corgi is targeting. Because initially, when I first saw that that first wave, it looked like you were going after the thematic ETF space and buffer ETFs. But with this most recent wave in June, there are more plain vanilla bond ETFs, again, at a very low cost, as you were alluding to. You have leveraged ETFs. So how are you thinking about which categories to target, or is it potentially everything?
Yeah, I think it's more of the latter, and I think Josh kind of hit the nail on the head there. Our goal is really to offer something in every category, but we have to start somewhere, right? So I think the two natural areas that Corgi wanted to first target were Like you just mentioned, kind of vanilla fixed income funds that, fit naturally. We are an insurance company. We do have tons of premiums that are being written. We have to reinvest that flow potentially somewhere. So that's a natural area for us to potentially invest some of our capital on the insurance side. And then I think on the other end of the spectrum, you kind of hit on, thematics and buffers. We see some of these more kind of niche or subsectors in the ETF space that we believe are kind of primed for disruption and fee compression. We've identified a number of those spaces being primarily thematic ETFs, leveraged ETFs, and buffer ETFs. And you've seen that, our launches have coincided with those specific categories to start. And so I think, starting with thematic ETFs, we wanted to offer themes that we really hadn't seen yet in the market. We're really trying to offer very targeted exposure to these investable themes. So things like semiconductor photonics, quantum computing, drones, sports betting, coffee and energy drinks. These are very targeted niche categories that, may be topical right now, or they may be topical in 6 months or 12 months or 24 months from now. So we're offering that targeted exposure for investors to express their views on those types of sub markets. We're really allowing investors to, express their views, and we're building them the tools for targeted exposures in the thematic space, all the while being at a low cost basis, right? So all of our thematic funds, for the most part, are 35 basis points. I believe the category average is somewhere near 60 or 65. And so, we think we're offering at a very attractive price point. Same goes for the leverage space. We're allowing these very targeted investment exposures, tactical trading vehicles that allow investors to take a view or an opinion, an outsized view, 2 times leveraged on, say, they're bullish on the Korean market because of the memory stocks right now, and so they want to get access to 2 times levered Korea or Taiwan. We're building, I think, first to market products in a lot of these categories. But we're also offering it at a rate that, we're really re-rating the system in a number of these categories. For our leveraged funds, we're offering at a baseline of 45 basis points, which I believe the average is 112 currently. 112 basis points is the current average for leverage ETFs. We're coming in at beneath 50% of the market, and we really think we're re-rating the space there. And kind of lastly on the buffer ETFs, this kind of goes back to a number of conversations we were having with some wealth advisors, but there's a number of incumbents in the buffer space. I think it's an attractive product, downside protection. You have a defined outcome. They're not the most sexy products on the planet, but we think that the fees have been astronomical for the last number of years. Issuers have gotten kind of resting on their laurels. They're a bit greedy. We're here to re-rate the space, offer a similar product at a much more attractive price point. And I think in particular for the buffer ETFs, when you speak to advisors, they love the buffer ETF as a concept, but they might just be priced out of it. They have to offer these things at, if it's 75, 85 basis points, in a separate account for their clients. They can't put these things in managed accounts oftentimes. And so we were trying to solve a problem and say, hey, what would be the rate at which this would be attractive for not only the end consumer, because obviously, at 30 basis points versus say 60, 70, 80, 90, you're getting, the same exposure for a lower cost. But how would this allow the advisors to kind of open up a larger pool of capital and put these in a managed account? And we thought 30 basis points and that expense ratio was an attractive price point that would allow for a larger pool of capital to potentially invest in these products. Whereas right now they might be priced out or putting their clients in a separately managed account where they can't charge fees on it. So we want to make sure that everybody wins in that category and kind of hit each part of the process there. So that's kind of a bit of where we're targeting initially. I think very high level. We're starting with what are we not seeing in the market with our thematic ETFs. I think we hadn't seen a number of those products in the market. Where do we think there might be investor demand in 6, 8, 12 months from now? And how do we kind of think about those things now? Because as it takes 3 to 4 to 5 months to get a product out the door. There's a bare minimum of review process with the SEC. So you really have to think about what's going to be the next topic or the next bottleneck or the next investable theme down the line. And I think we do a really good job of thinking about that here at Corgi, especially as we're able to leverage a lot of the artificial intelligence tools we have internally that are constantly scanning social media and the internet for kind of product ideation and thinking about what are some things we're seeing people talk about online that you might not be able to get if you're just sitting around a table internally talking to each other about, hey, this might be a good idea. Well, if you actually listen to the market, or you listen to the folks who are talking about these things, the product idea generation is very fruitful. And so I think we have we have an advantage there, and that we do those types of things, and we are leveraging our artificial intelligence models internally to kind of have great product ideation and build things for primarily for retail to start, but if we listen to them, you can build some really great products. And so yeah, that's just a high level overview. I'm happy to get into all of that, but yeah. We've got a great offering, but we're going to be building a lot more as well.
No, excellent overview. I guess let me pull two quick threads there. First, to your last point, just on the idea generation process. You mentioned, for instance, there's a coffee and energy drinks ETF. As I look at the lineup, I see a New York City-based ETF. There's a Bay Area-based ETF. I see a buy now and pay later ETF. Just talk more about how you go about the process of coming up with these ideas. Like, to your point, you're not just sitting in the Corgi cafe at 2 a.m. There's more to it than that. So give us a little more insight into where these ideas are coming from.
Yeah, I think it's twofold. And, maybe for the coffee and energy drink one, you might be sitting in the Corgi cafe thinking about that product. But yeah, I think firstly, we're looking for areas of the market where we hadn't seen targeted exposure. So, initially we started with kind of internally, hey, what are some niche subjects that we haven't seen other issuers offer product lines in? And we're looking at, for example, I hadn't seen anybody offer a lithography and semiconductor photonics ETF, our ticker EUV. I believe we were the first to market, and that's kind of how photonics is he's using light to do the work electrons used to do. It's how AI chips are actually talking to each other. And with the build out of all these data centers, this means, lasers and optical fibers, moving data between GPUs instead of copper wires. And I hadn't seen a product that was offering direct access and targeted exposure to the companies that were building in the photonics space. So that was a product ideation we had. And, I think EUV was maybe the fastest growing, ETF launch in all of May. So we're really proud of that. And that was kind of, hitting the nail on the head of what hadn't been offered yet. Where can we come together and think about, these targeted niche subjects that people are asking about or are talking about on the internet, and building it for them and for us, because I think it's a cool product too. Same goes with a number of our other offerings. Like we have sports betting and gambling. It's a bit of a vice subject, but sports betting is on the rise, especially amongst Gen Z, and offering a targeted approach to investing in a lot of the issuers who are playing in that space just hadn't been done before. So I think we're taking that approach first and seeing, what are some of the demands out there? What are some of the themes out there that haven't been met? And how do we build those? And then secondly, like I previously touched on, we are running a lot of models internally that are scraping the internet, scraping Twitter, Reddit, all these social media platforms where a lot of the retail community congregates and they talk to each other. And you can get a lot of, product alpha and figuring out what are the needs that aren't being met and how do we build new products around that. And so we're getting flags for, this topic is populating a lot on Twitter this week, or this is being talked about heavily on Reddit, and we should consider offering a product in that theme. So I think when we think about product ideation, especially in a thematic space, we're kind of going on those two levers and those two methodologies.
Okay, so that's the product idea side. The other thread I want to pull is just around the pricing strategy. And as you were mentioning, and I alluded to this at the top, overall, you're coming in with some of the lowest price points in all of these different categories. And I'll tell you, as somebody who's been in the ETF space for now almost 20 years, I haven't always seen that. Sometimes you'll see new entrants come in and they're not really willing to compete on fees. They'll come in at higher price points, or they'll try to stair step down over time, but it's too late, at that point. Can you just talk more about the pricing strategy here?
Absolutely. Yeah, I think, again, like I mentioned, I think a lot of the incumbents have been complacent for a long time and have kind of gotten, greedy with the fees. I think going back to the leverage space, for an example, people are paying 90 to 150 basis points for leverage, and I think that's kind of silly. We want to re-rate the entire category. We're offering the exact same types of exposure at more than half off. And so I think we're challenging the notion that, leverage needs to be expensive or buffers need to be expensive. And we're kind of trying to democratize that access and, lower the price points and barriers to entry for a number of these products. And I think, being first is great, and you want to be first in a number of these products, and that's key for a lot of things. But I think if you can't be first, you definitely have to compete on price, and I think that can attract meaningful flows as well. And I think, you kind of touched on it as well. It's hard for other new issuers to offer such low price points. And then that goes back to one, at the parent company level, Corgi is a very fastly growing business. We do have a great insurance business behind us. I'm not going to go hungry if I have to offer 150 basis points to make ends meet. That's not the case here, which that isn't true for all the issuers. They have to offer, quite a higher expense ratio to make ends meet, to pay their salaries, to do all that. We just raised a multi-$100 million Series B round that can sustain us. So, I think we want to re-rate the space in a number of categories. We think prices have been high for too long, but also we're very fortunate in that we're not like most issuers, and that we do have an insurance company at the parent level that is growing really fast and is really interested in this business. And most issuers can't say the same. And then lastly, I think I mentioned we are challenging just how ETF construction is done, just from top down. Like none of us came from the ETF industry for the most part, and so we don't accept all of the same costs or the same practices. You have to pay for this, you have to pay for that. We're internalizing a lot of the processes. We're leveraging AI to the max. And the scale of our operations, frankly, allows us to negotiate very heavily on rates with a lot of our service providers. So our break-even costs are quite low. I think we're able to pass those cost savings along to the end client, the end consumer of these ETFs. So, I think it's two or threefold there, but we're pretty excited to offer these lower rates. And you'll continue to see that from us moving forwards.
I just find this all fascinating. I'm not sure if you both are aware, but typically this industry, it's called the ETF terror dome because the competition is so brutal. And so if I'm thinking about this from a VC perspective, you have highly entrenched competitors, including some of the largest asset managers in the world, or all of the largest asset managers in the world, the Vanguards and BlackRocks of the world. You do have cutthroat fee competition, though I think to your point, there are clearly some categories where fees are still elevated, but competition around fees has always been something that we've seen in this space. Distribution can be a huge challenge. I guess my point is this doesn't necessarily jump out as an area ripe for disruption, but clearly Corgi thinks that it is. And you're not scared to come into the Terror Dome and compete. I don't know if you want to comment on that at all. I find it's an interesting dichotomy here.
Yeah, for sure. We're definitely entering the Terror Dome. We're competing eventually with the likes of the behemoths like BlackRock, like Vanguard, like State Street and Invesco. We're not trying to put ourselves in a box early on, like I think a lot of other issuers maybe have done, as, hey, that's the leverage issuer or that's the thematic issuer. We're really taking that broader scope approach, and I think offering more choice is key. More access is always better. I think fee competition is brutal, right? And I think we're the ones compressing and challenging the current fee structure on a lot of these subsectors. So we think that's important to us. Distribution is really difficult for new entrants. I won't lie about that. I think distribution dynamics and kind of a lot of the gatekeepers of more institutional capital, if you will, require a lot of time in the market and relationships being built. We totally understand that. And we're seeking to build those relationships over time. We figure why not launch a lot of these products now, so that I think part of the gatekeeping is a time component, right? You have to have a certain amount of time in the market. You have to have a period of time return. So why wouldn't you start the clock now and start offering those products so that you can have those conversations in 1, 2, 3 years down the line with the larger institutional type allocators. But I think in the meantime, while we do build up those relationships, we build up that trust and brand image and get people to know who we are. I think the largest opportunity is amongst the self-directed retail community. I think it's a $12+ trillion market. It's still largely untapped or hasn't been fully cornered by a lot of these behemoths like a Vanguard or a BlackRock. And I think we feel quite in tune with that area of the market given our relative age. I might be like the second oldest person at our team, and I'm 27. So we're constantly online. We feel very in tune with that area of the kind of the retail crowd, and we believe offering targeted thematic ETFs, leveraged funds are areas of which retail really likes to talk about constantly on the internet. And we find there's definitely many mediums that issuers, don't know how to channel yet, whether that's on X or on Reddit or on other types of, up and coming platforms. I think there's a lot of spaces. There's a lot of white space that hasn't been tapped into yet that I think a lot of the Terradome large players just aren't playing in because they're focused on their institutional clients. So, I think we have some advantage there in that regard. And then lastly, I think, because of the fact that we work 7 days a week, we have an extra 2 days on basically everybody. And we're a team of problem solvers, right? So our founders at the parent level, they never worked in the insurance industry prior to this, and they built a $2.6 billion insurance entity. We will find a solution. We're going to work tirelessly to figure out what the next best distribution channel is. We move incredibly fast. We're very nimble, and I can confidently say we will outwork everybody.
I mentioned at the top that Corgi does have a bunch more ETF filings with the SEC. I believe I saw there were another 40 ETFs filed for just yesterday. And so I don't want to put words in your mouth. I'm assuming we should expect to continue to see these big waves of launches. Is there anything else you want to tell us about the path ahead for Corgi ETFs?
Absolutely. And you can definitely expect to see many more waves of launches on our end. But, I think there's multiple avenues of expansion, and we're really just getting started. I mean, we only began less than 6 months ago. We've got 88 products live on the market. We just crossed over $610 million as of yesterday. So we're growing very quickly, but I think there's multiple avenues of expansion. Like I touched on prior, self-directed retail is still, I think, one of the most overlooked yet important capital allocators in the space. Offering more access to more types of investments that typically haven't been able to have exposure to, I think, is key. I think firstly, looking at potentially private market exposures are really interesting. As companies continue to stay private for longer periods of time, I think providing access to some of those names could be quite interesting. And we're seeing a number of people start to, put direct shares of private companies in funds to the degree they can. Look at Stripe or Databricks. They're on like their Series H or I or something, or they're just going through the alphabet at this point before going public. It'd be interesting to have, funds that might have access to those kinds of names. I think offering, harder to reach, maybe ex-US names in a lot of these themes is an avenue we're looking to explore. I think there's a lot of great companies in Europe and LATAM and parts of Asia that are quite topical, but they're really hard to reach in the retail brokerages. And so packaging that up and offering it in the ETF wrapper is definitely key. A number of our competitors have done very well doing that. And we think that's a huge area for exploration and expansion. And I think lastly, the biggest avenue really is kind of offering our services to others, right? Or white labeling products. We've built a full stack platform end to end in less than 6 months. We have our own trust structure. We have internal trading capabilities, portfolio management systems all in house. And so we have the capability to take other people's ideas and bring them to life. And I think there's a really big opportunity there because so many people have so many great ideas that are either living in an SMA or a hedge fund strategy or something, and they can benefit from, putting it in an ETF wrapper. And I think we're very capable in our ability to do that for other folks. And we actually already have done that for a client, and we're working with a number of other folks who are interested in building their own ETFs as well. So we think that's still an untapped area of the market and an area of expansion for Corgi. And we want to allow other folks to offer, their ideas. We've got plenty. There's no shortage of ideas here at Corgi. As you can see, and you alluded to, we have filed for a number of products, but we also want to hear from other folks and hear about what other strategies they might want to see in an ETF wrapper, and we'd be happy to work with them to help build their product and have that come to life too. And as I said, we're going to move faster than everybody else in the market. Speed is paramount to us. Our motto at the parent company level is AI, or is insurance at the speed of compute. We want to move extremely fast. And as you noted, you'll get emails from us at 2:00 in the morning on a Saturday. We're working all the time, and so you can't match that level of service with prospective clients. And so that really matters to us. Speed is key, and we'll work fast from ideation to prospectus filing to eventually getting out the door quicker than anybody else. So we really think that's a key area of expansion for our business.
Well, Anthony, Josh, simply fantastic insight into Corgi's ETF business. Really appreciate that. Congratulations on the launch of the ETFs. You've certainly made a huge splash into the ETF space overall. Wish you all the best of luck moving forward. Thank you very much for joining me.
Thank you very much, Nate.
Thanks so much for having us, Nate. Appreciate it.
That was Anthony Crinieri and Josh Jung of Corgi. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Paul Bayaki, Head of Fund Sales and Strategy at SS&C Alps Advisors. So we'll discuss some big ETF trends right now and take a look at several Alps ETFs. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.